Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Qunabox Group Limited annual report. Qunabox Group Limited is a multifaceted business that offers a range of services to cater to various needs. At its core, the company provides marketing services, which include promotional activities designed to boost brand awareness and sales. In addition to marketing, Qunabox also engages in merchandise sales, allowing customers to purchase products through their online platform or vending machines. The company's innovative approach to product distribution has made it a convenient option for consumers. Furthermore, Qunabox offers cutting-edge technology solutions through its AI interactive and big data products. These services utilize advanced algorithms and data analysis to provide valuable insights and improve business operations. The company also provides IT system development and software development services, enabling businesses to streamline their processes and enhance efficiency. With a strong focus on innovation and customer satisfaction, Qunabox Group Limited has established itself as a reliable partner for businesses in mainland China. The Qunabox Group's stock price has experienced a drastic decline of over -76.65% in the past year due to a substantial net loss reported for the fiscal year ended December 31, 2024. The company incurred an attributable net loss of 1.67 billion yuan, a significant reversal from its previous year's profit. This considerable loss was mainly attributed to one-off non-cash fair value losses and changes in the fair value of preferred shares. The announcement of these financial results led to a sharp decline in the company's stock value, with Qunabox Group's stock falling from $137 to $17.81 within its 52-week trading range. Although the company has since returned to profitability in 2025, the impact of the 2024 loss remains the primary cause of the stock price crash. The substantial net loss and subsequent decline in stock value have had a lasting effect on Qunabox Group's financial performance. Qunabox Group Limited market capitalization of 5 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Qunabox Group Limited holds a significant advantage in their industry. Qunabox Group Limited trades at a lower price-to-earnings ratio of 3 times and a higher price-to-book ratio of 2.35 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The balance sheet appears very conservative, with liabilities representing only 26% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline can be identified from the extracted summary. On the growth side, several factors have contributed to the increase in revenue. Marketing services have seen a significant jump of plus 27.8%, with value-added marketing services growing at an even faster rate of plus 32.9%. The adoption of AI technology has also played a crucial role, as has China's stable economic growth and the company's AI plus consumption scenarios strategy. Increased investment in underlying technologies and platform capabilities, launching innovative products, and expanding service scope have all contributed to revenue growth. In addition, the expansion of terminal network sites in high-potential cities, optimization of product portfolio, and leveraging intelligent operation systems have also driven revenue growth. The company's focus on AI interactive marketing products and data strategy products has led to increased R&D investment, further contributing to revenue growth. On the decline side, merchandise sales have seen a decrease of -5.2%. This is the primary driver of revenue decline. The net income of the company underwent a significant transformation over the period under review. Initially, the company reported a loss, which was subsequently turned into a profit, marking a 100% increase in net income. Furthermore, the net income also experienced a notable growth of 27.1%, rising from RMB 749.8 million to RMB 953.3 million. The improvement in net income can be attributed to various factors, including an increase in gross profit margins across different segments. The company's overall gross profit margin rose from 56% to 57.3%. Additionally, the marketing services and merchandise sales segments also witnessed a boost in their respective gross profit margins, increasing from 61.9% to 62.4% and from 23.7% to 25.4%. These improvements in profit margins contributed significantly to the company's increased net income, indicating a more efficient operational performance. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The data shows a substantial increase in cash generated from operating activities, rising from RMB 892 million to RMB 1,506.1 million between 2024 and 2025. This upward trend suggests that the company is efficiently managing its resources and generating sufficient revenue to cover its operational expenses. Furthermore, the unutilized amount of $137.94 million from the global offering provides additional evidence of the company's strong cash position. This indicates that it has a substantial cushion to meet its financial obligations, reducing the risk of liquidity constraints. The discussion on page 23, although indirect, reinforces this conclusion by suggesting that the company likely generated positive operating cash flow based on the increase in working capital. Overall, these indicators collectively suggest that the company is indeed generating positive operating cash flow, which is a crucial aspect of its financial health and sustainability. The company's debt level and interest expenses have undergone significant changes over the past year. A notable increase in bank borrowings has been observed, with a 25% rise recorded on page 13. This upward trend is also reflected in the total debt, which has increased by RMB 108,100 as stated on page 23. Furthermore, the interest expenses have also seen a substantial hike. The interest on bank borrowings has risen from RMB 11,738 to RMB 17,291, as mentioned on page 31. Additionally, finance costs and interest expenses have increased significantly, with a jump from RMB 11.9 million in 2024 to RMB 17.5 million in 2025, page 11. The total finance costs have also seen an increase, rising from RMB 11,930 to RMB 17,466 as stated on page 31. These changes indicate a substantial rise in the company's debt level and interest expenses over the past year, suggesting that the company may be facing increased financial burdens. The performance of various segments and regions has been analyzed based on the extracted summaries. Notably, certain areas have stood out for their exceptional performance. Marketing services have shown significant growth, indicating a strong demand in this sector. In terms of geographical locations, 3 cities have emerged as top performers: Hangzhou, Chengdu, and Ningbo. These cities have demonstrated impressive results, suggesting that they are hubs for economic activity and innovation. The success of these regions can be attributed to various factors, including favorable business environments and strategic investments in infrastructure and human resources. Overall, the data suggests that these segments and regions have been driving growth and progress, while others may require further analysis to identify areas for improvement. Management is optimistic about the company's outlook, citing healthy growth in its core business, the marketing services segment. To build on this momentum, the company will expand its service scope and leverage its innovative business model to drive further expansion. A key area of focus for management is technological R&D and innovation, particularly in AI interactive marketing and data products. This strategic investment is expected to enhance the competitiveness of the company's products and services, as well as empower brand customers' digital marketing transformation with new AI-powered tools. The company's long-term vision involves building a cross-regional full-chain AI lifestyle platform through its core strategy of AI plus consumption scenarios. This ambitious goal is underpinned by management's expectation that AI applications will enter a period of accelerated large-scale implementation, leading to fundamental changes in lifestyle paradigms. To achieve this vision, the company plans to expand its terminal network and increase market penetration by 32% by December 31, 2027. Overall, management strategy is centered on leveraging technology and innovation to drive growth, enhance competitiveness, and transform the way customers interact with the company's products and services. There is no significant activity to report on acquisitions and divestitures. The company has not made any notable purchases or sales of assets, subsidiaries, or businesses during the period under review. This suggests a stable and focused approach to business operations, with no major changes in its portfolio or structure. As such, there are no new developments or transactions to highlight in this regard. There are valid concerns regarding the state of inventory and supply chains. The data suggests that inventory levels have increased, which can be a sign of inefficiencies in the system. Furthermore, the decrease in inventory turnover days indicates that products are not moving as quickly as they should be. This slower movement can lead to a buildup of inventory, potentially causing stockouts or overstocking issues down the line. As a result, there is a legitimate concern about supply chain disruption and the potential for inventory buildup. That concludes the financial summary for Qunabox Group Limited. Feel free to comment below, and I will be happy to answer them when possible.